Richard, good morning. How are you?
Dylan, great to see you. Good morning. I'm very well.
Cool, very good. So Richard, you were a managing director at JP Morgan, spent, I guess, 15 years in banking, really reached the pinnacle, TMT, FIG, the big paychecks. Really interested to kind of understand your journey as kind of a point of departure. That's a comfortable position to be in. Startups, where you became first a founder and now an advisor and even ecosystem builder for startups. That's very uncertain. Tell me about that pivot and kind of why you did that and how that went out.
Well, bizarrely, I'd say it wasn't necessarily a pivot because when I started in banking, which is a couple of years ago, it was post Big Bang. Banking was actually transforming itself from being a fairly staid, boring, clubbish industry into something that was a great deal more entrepreneurial, where there was actually a need for innovation, where there was actually a need for figuring out how to get deals done that on paper shouldn't be done.
Mm.
So the thing I got a kick out of in banking was figuring out how to do deals.
Mm.
So in a way, nothing's changed. Banking changed. And by
Yeah,
the time I left banking in the early 2000s, it had become slightly again a very sort of locked down, institutionalized business.
mm.
So in a way, I've continued doing the things that I enjoy,
Mm.
but in a different framework, a vastly different framework, without the
Yeah.
comfortable office, without the useful business card.
Mhm.
So it's a very different proposition. Um,
Yeah,
and I've had to sort of knock a lot of sharp edges off myself
yeah.
in order to make that adjustment because it is not straightforward.
Yeah. I must say, I thought that doing M&A in a boutique kind of later in my career, that it felt, because I'd been an entrepreneur after leaving kind of the bulge brackets, had gone to business school and come back to M&A, and I felt that it was as entrepreneurial, really, in a lot of ways, because you had to be creative, you had to spot opportunities, you had to pound the pavement, you had to work pretty hard. The difference is you ended up with 1.5 to 2% of kind of a deal transaction value, and you see the entrepreneurs having the fun, the fun work and starting a next stage in a journey. So I definitely get that. So I guess the one difference is the paycheck, which is nice, and I guess
The
yeah,
visibility of paycheck is obviously a very significant
yeah.
thing, and
Yeah.
obviously in the world that we now inhabit, the certainty over whether or not you will eventually get the paycheck is somewhat different as well. And
That's
that's this
true.
whole
Yeah.
probabilities thing.
Yeah, cool. So you've had a long career, done a lot of things. I guess for this conversation, it'd be interesting to focus on two of them. So first, Capital Pilots, and now your new project. So Capital Pilot, we actually use Capital Pilots as what was called Abaton, which is code name when we were in stealth, and found it great. But just perhaps in your own words, so Capital Pilots measured investability in its essence, if I'm correct. Like, what does that mean?
I've been rating startups for 10 years, and Capital Pilot was the first um, embodiment of that. And it was about trying to figure out ways of putting a number on the key factors that make a startup successful.
Mm.
Why? Because the world of startups is prone to subjectivity and bias. Not surprisingly, there's not much data about a startup because it's a startup. You don't have 3 years of financial track record. You don't have large data sets about your customers and so forth because you don't have any because you're a startup. So what was it about a startup that could be measured and could be benchmarked such that you could say this is a better company which is more likely to succeed versus this one which has factors which make it look as though it's less likely to succeed? And what we constructed at Capital Pilot was a schema which allowed a team of very carefully trained assessors who were mainly business school students interested in
Mm.
learning about the VC marketplace to answer in as objective a way as possible lots and lots of questions about a business. And the compilation of the outputs of three assessors were then turned into a rating and commentary, which was intended to provide a startup with key indicators about how likely they were going to be to raise money and what they might be able to do to increase their probability of success. That was
Okay.
Capital Pilot.
Okay, very interesting. So it's almost the concept of the super forecasters where you have multiple but non-specific kind of generalists look at something kind of very objectively and average it out.
Super
Okay.
Forecasters was actually one of our
Yeah.
little Bibles. The other little
Okay.
Bible actually was Black Swan. So
Ah,
all of
okay.
the silent evidence, hidden evidence, all of these other
Mm,
concepts around information advantage
yeah.
and getting to the real truth of the matter rather than listening to the talking heads. So that's where super forecasting
Yeah.
and Black Swan combine. And I guess the ultimate embodiment of the Capital Pilot business model was the Boost Fund. And this
Mm,
was designed to attack a slightly different element of the issues in early stage fundraising. That is the paucity of funding for early stage businesses
yeah.
and the uh, asymmetric returns that are required within a normal VC portfolio in
Mm,
order for that portfolio to be successful.
yeah.
So if you've got a portfolio of 10 companies as an investor, one of those businesses really, really needs to be super successful to pay for the likely mediocre or negative returns, if you like, of the others.
Mm,
And what we were interested in was changing the dynamic there and saying, well, what if you could invest in a very large portfolio where you get all of the benefits of diversification
yeah.
and you can offset the costs involved in making each investment, which is the amount of human time required, by
Mm,
automating many of those processes. And the
yeah.
Boost Fund made 50 investments in 3 months flat by providing funding on fixed terms to businesses that got a high rating. So if you hit
Yeah.
the rating threshold, here's your term sheet, sign that, here's your money.
Yeah.
Um, and that was not only a massively supportive thing for the startups involved, but also we feel a much better deal for the investor at the end of the day.
Yeah, yeah, sure. I want to ask a little bit more about that. Before I forget those, you said key factors of success. This is your key IP clearly, so you're not going to give the cheat codes away, but very broadly, I remember the proposition was basically you would submit your deck and then you would actually get quite a lot of feedback. It was about 25 pages or something of, so here's, I guess the things that investors are looking for, here's how you rated on each of those, and here's therefore how you could improve. We got a very good mark, by the way, so thanks for that. Um, what are kind of broadly some of those kind of like key factors that you were looking at in that?
It's a slightly glib answer, but effectively, if we were to go out and interview VC associates
Okay.
or principals
Yeah.
and say, what are you looking for in a startup?
Yeah.
If you interview 50 such people, actually the answers come out pretty much the same.
Yeah.
They might come in a slightly different order. So, oh, it's all about the team.
Mm,
Somebody else might say it's all about the distinctiveness of the product or service that this company is taking to market. But it's always 10 to 15 items on a list. And it's
yeah.
about the attractiveness of the target market. It's about the distinctiveness of the product. It's about the
Mm,
business model, the revenue model, and its
yeah.
fit within that target market. It's about the operational capability of the team and
Mm,
its probability of success in driving that particular business model in that particular market.
yeah.
Um, and so it's a lot about the things that are behind the pitch deck rather than just the pitch
Yeah.
deck itself, but the pitch deck is the window to that business and
Yeah.
effectively the first stage in the process. So our deal with the startups was to say, let's be like the first VC that you approach.
Yeah.
And
Yeah.
let's give you the feedback that you'd get if the VC were to give feedback.
If they were to give feedback, yeah, which they probably
Issue.
don't. Yeah. Mm,
Let's give you that feedback in a structured form with numerical indicators of where you need to improve.
mm. Yeah, yeah, that's brilliant. And as you say, you don't get that feedback. And I think everybody knows those 10 things or 15 things. You see them, people, paste and repeat those on LinkedIn all day long of all of those, Sequoia's 10 and the other one's 10, and they are all pretty much the same. But I guess the trick is what's underneath that and how well it's actually articulated and whether it really comes through, because everybody can have a slide that says target market. if it's not compelling, what's underneath, it doesn't get you through. So the Boost Fund, you made 50 investments, you said, right?
Right.
Cool. And that's, it's relatively early, but how have those fared so far?
The stats behind investment in early stage business, or the stats behind survivorship in early stage business, are pretty poor.
Yeah.
So failure rates running upwards of 80%.
Yeah.
And that's even for businesses that have received their first round of funding.
Yeah.
The 2 years in now to the Boost Fund portfolio, it looks like we've got about a 20% failure rate.
Really? Wow, that's insane.
There's an exit,
Yeah.
which happened actually within the first year.
Really?
At 3x.
Yeah.
And there will be, as always, that dispersion between the high flyers and the ones that are bumping along.
Yeah.
What others would call zombies. So they're surviving, but barely.
Yeah.
But case proven, if you like, in terms of the dispersion effect.
Yeah.
For two reasons. One is because you'd expect that if a company was going to fail, it would fail earlier.
Yeah.
Rather than later in the normal time span of an investor's time period. And second, because the anecdotal evidence suggests that those individual businesses that were invested in are doing better than average.
Yeah.
So the rating worked as a way of selection, and the size of the portfolio worked as a means of deriving value for the end investor.
Yeah, yeah. I mean, those are insane statistics. And 2 years is a good number, isn't that? Because that's more or less a typical runway. So if you're still living now, and that's, when a lot of those 90% is the number that I always hear of, have probably not got to the next funding and are no longer still kicking. Wow, well, congratulations. So, like, when you look at that portfolio, and I'm not sure kind of how much post-analysis you've done or could share, what do you think are the kind of three things that the most successful companies, or the couple of things that the most successful companies tended to exhibit? So before you had kind of an expectation as to what was going to be successful, like what really stuck out as ringing true?
Another glib answer, I'm afraid, but what stuck out is the difference and the diversity. And again, the demonstration that we had a real mix of founder types, business types, sector focus, revenue models.
Yeah.
One example was the fact that in a marketplace which tends to invest about 10% in female founded businesses and barely more than that in ethnic minority founded businesses, we had 44% female founded businesses and 42% ethnic minority founded businesses in the Boost Fund.
Oh, wow.
Not because we tried.
Really?
It was a target, it was an aspiration, but we didn't do anything to force that. We simply had a process that was agnostic, bias free, and welcoming.
Yeah, and then that's what came out.
So truly, it's terribly easy for people to post-fact rationalize and say the key thing that made this business successful or this portfolio successful was X, Y, and Z. And I believe I will say until every single last Boost Fund investment has been exited, that the key thing about that portfolio was its diversification.
Yeah, it's really interesting because if you look at the ETF market, and I spent time as an equities analyst, where you have layers of people, of buy-side analysts speaking to sell-side analysts, and sell-side analysts, having internal strategy teams and all these things, and everybody, getting paid quite well for it. And then you just look at the data, and it's, just objectively, I mean, it can't be argued with the fact that after fees, the analysts underperform. Not only that, but the ones that underperform the next year. So it's all random. So the best thing you could do is just have all of the money tracking the markets, and in some way, by automating a lot of the investments process, what you've done, you've just taken out a lot of potentially expensive VC associates and others, and deployed that money instead in a wider portfolio, which is diversification that seems to win. So it's pretty compelling.
Correct. We halved the fees. We had the ETF very much as our model.
Okay.
And if you like, ETFs run because you have companies that are part of indices.
Mm.
So you've got the FTSE 100. Those are all
Yeah.
companies that have effectively qualified to become part of the FTSE 100,
Mm.
if only because they're big. And in our world, you qualify to be part of the ETF equivalent for startups by getting
Yeah.
a high rating.
Yeah. Yeah. Yeah.
So that's
Very
what gets you in
interesting.
the club. Then you get your investment, and then
Yeah.
effectively, from the investor perspective, you're buying the index.
Yeah. No doubt something you thought about a lot before. We won't go into it now, but the VCT model must be kind of interesting from that perspective. It could be automated. I think it's quite heavily regulated though, so probably not
Quite
as
heavily
possible.
regulated,
Yeah.
getting past the industry standards around
Mm.
the requirement for the deployment of human expertise in the building and managing of
Yeah.
portfolios. All of these things are complex. We're very far from done, though.
Yeah.
I am very far from done in
Yeah.
terms of building big portfolios to make sure that every startup that should get money does get money.
Yeah. Yeah. Well, good to have people like you doing that. It is interesting that you've actually got a regulation protecting it's almost like an old guild or something, isn't it? That you wonder how long that'll last because, AI is clearly able to do a lot of things. I was going to ask that at the end. So I'll save that for the end. So, okay, so you developed a huge amount of IP in being able to identify factors for success for companies, helping them to articulate themselves better, and then deploying capital in them. You've now almost changed sides of the table in a way, or taking a different view with VentureCubed, and that's something I guess people would know a lot less about. So perhaps it would be great to kind of hear a little bit about that and what you're doing with VentureCubed.
Venture Cubed carries on the theme. So it's still about ensuring that we can find those signals, that we can quantify success potential for startups. The remit is slightly broader. And you just mentioned AI. AI is a massive factor in this. So we started working on VentureCubed at the beginning of this year, 2024. And we had at our disposal a completely new toolkit, which meant that
Mm,
we could build quick, iterate quick, and
mm,
deploy the power of large language models to do the work that the human assessors used to do in the world of Capital Pilot.
mm.
And that brings with it its complexities, no doubt. But at the same time, it's a more cost efficient model and probably reduces further the risk of subjectivity. So even if
Yeah,
you've got three human assessors, you could still build in a subjective bias to your
yeah,
outputs. So we can now turn around an assessment in a minute
mm,
as opposed to a week.
yeah,
And the outputs are immediately flashed up on a dashboard for the client
mm,
to see. And the key difference about VentureCubed is who's our client, who's our
yeah,
principal client. The principal client now is the VC, the
yeah,
accelerator, the public sector support organization. And what we're doing for them is providing them effectively with a filtering or screening tool.
yeah,
So a VC that sees 3,000 applications per year and
mm,
has a team of 5 can now see the identical output on all 3,000.
mm,
And they can effectively draw their own line and say, well, we're not going to look at businesses that fall below this line,
mm,
measured both in terms of the inherent success potential of that business, but separately in terms of the fit against that investor's investment criteria.
yeah,
So here's your dashboard, here are all your applicants, and you don't need effectively to spend unnecessary time on
mm,
looking at the ones that are never going to be a good fit.
yeah,
Focus your time, focus your energies, keep your costs nice and low, and be much
mm,
more efficient. And the humans get to do the things that humans are best at, which
yeah,
is the deep
yeah,
dive.
yeah,
We've also added to that a mapping tool, and the mapping tool effectively, again, making full use of the new tools available to us all, is identifying all the data that's available about an individual early stage business, categorizing it in a useful way as opposed to apply an SIC code to it, which, let's face it, is not particularly useful these days. And identifying characteristics around descriptive characteristics, scale potential characteristics, and ultimately contact details as well, so that mapping tool can be used to give a view of a geographic region. Who are all the businesses within this region, the high growth and the non-high growth businesses? And if I'm looking for a certain type of business, how can I identify them and reach out to them through that tool? And that really shows the ability for us to look at the entire marketplace and then the deal flow within it to give a true view. And it's perhaps the first true view that's been possible about the entirety of the market. So how many startups are there in the UK? Nobody knows. Best estimate, about 50,000 created each year. There seems to be a massive gap between those 50,000 created each year and the roughly 2,000 deals that are invested in at early stage in the UK each year. So what's going on with the 48,000? And in fact, it's not 48,000 because you might be on a 3-year journey before you get to fundraising time. So it might be 150,000 companies that are turning into 2,000 investments ultimately. So what's going on with the rest? Because if there's an economic potential to be unlocked, there's a pretty high degree of probability that it's within that mass of high growth potential startups that are established but don't make it to fundraise.
So that 48,000 or 148,000, I guess many of them are not incorporated either. So you would really have no knowledge. A lot of them are probably no good, but there are probably a bunch of them that are good. And probably within the 2,000, a lot of them probably should have been in the 48,000 also. So by kind of mixing it all around, it's
12% of them are good. We can say that 12% of them are good, which is a great deal more than 2,000.
So you might have been able to swap out that 88% for some of the 48,000 that might have been better. So you're starting with, there's a whole lot of data that goes into this. I guess a key one of them is the deck or the grant application. So again, the key factors of success, I'm probably not going to force you to caveat your answers glib by saying that the key factors of success are pretty much the same as what you have always viewed before, because that's the IP I'd learned. And there is no right answer really, because there's a lot of diversity, and any one of those can be better than others. So it again comes a lot back to how well you can clearly articulate something that's true, but getting that across correctly is everything, and kind of filtering you through that process, even if it's a good process or an objective process like yours.
Well, I guess a little pushback there. There are 2 or 3 key things that we're more able to do now than we were before. Because this is now a fully automated process. And one is that we can ensure we place each company within its proper context. So there's no point saying to a business that is at idea stage, well, you don't have traction because there are no revenues. Well, of course there aren't, because you're at idea stage. So what's the traction measure that's appropriate to an idea stage business? So if you're an idea stage business looking for angel funding, probably, what should you be able to demonstrate in terms of traction? It's probably about the fact that you've spoken to loads and loads of people. You might have a website that's got a waiting list on it. You're probably quite a long way away from revenue, but people are saying that what you're doing has merit and potential. So relative rating is really, really important. And the other thing actually is that we can be a lot more granular, because you bore a human assessor quite quickly if you ask them too many questions. You never bore the machine. So our list of factors that we assess is vastly greater than it was in the human era. And then the second thing to say there is we've got a much better ability to ensure that we're going out and identifying all relevant information about that business, its market and its competitors, wherever that information may reside, rather than relying more heavily on the pitch deck. And this goes back to one of my previous comments, which is about the fact that it's really important to see beyond the pitch deck to the underlying proposition. so that you can say, beautiful pitch deck,
Yeah.
ticks all the boxes in terms of content, but there are
Yeah.
some severe weaknesses in that business model. Or conversely, which we see more frequently, I've never seen such an ugly pitch deck in my life, but there's some really cool stuff in there, and a
Yeah.
business model that, if expressed, if presented better,
Yeah.
would get many people excited.
Yeah, but there was articulation in there. It just might have not have been well designed, because the articulation there was enough for the system to pick up the signal and say, it was a 28 size times numeral times Roman bullet points, but what it said was actually kind of like magic. Cool. So, when you look at these businesses, we're obviously in the business of intangible assets like IP and data and code. Just wondering kind of where that factors into, the way that your systems kind of look at businesses.
I'd have to say that it's work in progress.
Okay.
First thing, we haven't got everything absolutely nailed down in the way in which we'd aspire to have it. And I suspect there may well be a conversation for us to have there. The approach is to say IP isn't always one of the most important factors.
Yeah.
So depending upon the type of business that we're rating, it may be more or less relevant to an overall rating.
For sure.
So first of all, let's figure out which sorts of businesses IP is relevant within. And second of all, let's identify what things we should be finding within that business, whether or not expressed in its pitch deck.
Yeah.
That would give us comfort that that business is protecting its IP and building its IP in the way in which you would hope.
Yeah.
And I guess you know this a great deal better than I. There's both a defensive element to IP, and there's also, if you like, the offensive value creation side to IP.
Yeah.
And we're probably currently stronger on the defensive side. If you're an IP dependent business, do you properly control that IP?
Yeah.
And we probably have further to go, even though actually this takes me right back to my roots 10 years ago, 11 years ago, where we were looking at how relevant IP might be to the value of a startup or its investability. We've probably got more to go in terms of how we might signpost IP strategies for value creation.
Yeah, it is a really interesting space, because the data will tell you that it is just the case, full stop. So the EU IPO did a very large study on many startups, and they found, for example, that companies just with like a trademark or like a patent had, in cases 10x more likelihood of getting funding. And then I think the number is 3x more likelihood of a successful exit. They also found, for example, much lower incidences of default rates. And then when defaults, loss given default rates, how much money was actually lost if you do get in trouble. Now, cause and effect, obviously hasn't been proved. But you would just have to say that clearly IP is playing a massive role there. Either companies that have their eyes on IP intangible assets and treat it correctly, it's a signal of them being better managers, and because they're better managers, they have better outcomes, or it's actually the IP that is doing some magic, or most likely actually kind of both. So really getting into that and understanding how to extract that clear kind of market outperformance will be something exciting. Yeah, we've been experimenting with a lot of those tools as well, and it's incredible that once you've got the know-how to identify certain things, as you do with factors of success of business, as we do in some ways of understanding the likelihood of having assets, you can actually point a large language model fairly untrained, with just a little bit of kind of like prompting to say like, this is the context, this is what you're looking for. And outside in, just looking at press releases, customer testimonials, all of these types of things, a model will actually come back with a pretty good guess, because the types of companies as to, 50, 60, 70 likely intangible assets it has. And yeah, but I guess you can benchmark with that, right? So if you look at a lot of companies, as you do, you would know if you're in this sector, all of the good ones have typically, protected or have extracted value of these types of assets. Have you not? And if you have not, then, you know, probably not a good thing.
And I completely get that. I've got always, when I hear data like the EU IPO data that you just referenced, I always have a slight concern that that data is asking the right question of the right people. So I think there could be other biases at play there.
Yeah.
And I think it's perfectly possible for a business to be successful to a certain point in its development stage.
Yeah.
So I think it's stage specific.
Yeah.
Without that business having been through the process of registering even its trademark. So I think there's room for questioning, but undoubtedly I get the general point, which is a better managed business, let's call it at Series A and beyond, is likely to be the business that's protected properly its IP and got a proper IP strategy.
Yeah, sure. Look, I mean, I'm sure there's a lot to dig into that data. I think it's, you know, they're fairly serious people, so they would have had a big enough sample, and it would have been companies with and without and controls. But I think just the scale of kind of those differences warrant, you know, means there's something there. And even if you're going to control some biases and whatever that is. Cool. All right. So I was going to kind of finish up by asking you. So you've seen effectively kind of both sides of startups, and you've advised kind of both principles. What would you say is kind of the key advice that you would give to a startup, you know, call it seed, Series A, or even kind of earlier, about articulating its business to maximize its chance of getting through and getting funding?
The thing that comes across to us most frequently is the weakness of the startup's ability to put themselves in the investor's mindset. And that's multiple. That's about engaging with engaging collateral.
Yeah.
More fundamentally, and often missed, is getting the maths right. So thinking back to what we were talking about earlier in the conversation about portfolios, here's an investor who's got a portfolio of 10 investments that they're going to make this year, let's say for the sake of argument. Could you, as a startup, be one of the ones that could be 10, 20, 50x?
Yeah.
And effectively, in inverted commas, pay for the businesses and the rest of the portfolio that are going to do less well.
Yeah.
So the investor thinks power law. One business massively outperforming the others and paying for the relative underperformance of the others. So if that's the way investors think, how do you put your business within that context and demonstrate? So there's this thing about ambition versus conservatism.
Yeah.
And it's a really tricky blend. How ambitious do I need to show that I can be without looking overzealous or crazy? And do you ever get any points for being conservative?
Yeah.
Oh, well, my financial projections are conservative. Well, if your financial projections don't demonstrate that you could be a 10, 20, 50x business, then you're straight out of the door.
Yeah.
So conservatism has no value in that case.
Yeah.
But there's this broader numbers game. There are two angles to the numbers game, I guess, I'd like to just briefly mention. One is the fact that each investor sees 2,000 deals and makes 10 investments. So there's a really low probability that you're going to be one of them. The numbers suggest that 12% of those 240 of that 2,000 are going to be good deals.
Yeah.
And even of that 240, they're only going to make 10 investments.
Yeah.
So how do you make the numbers game work as a startup looking for investment? Because every single time you go and meet with a VC, the high probability is they will not invest in you.
Yeah.
And so you have to play the numbers game a little bit as well, but without just spraying wildly, because the further you go down your list of potential investors, the even less likely it's going to be that they're going to be. And the other related factor actually comes back to sort of startup mentality. And this is something.
Sorry, Richard, how do we play the numbers? What's kind of the actual advice on that? It's to make sure that you are as differentiated as possible within reasonable bounds, knowing that that's the context, that there are 2,240. It's about really appreciating that and knowing that that's what you're fighting for, not just speaking passionate about your own kind of project.
Yes, so it's absolutely. So it's first of all making sure that you really get the investor context, not just in general, i.e., how do you make yourself the 0.5% candidate? But it's also about ensuring that you've ticked all the investors' boxes. And that's very different from having the right slides in your pitch deck. It's much more fundamental than that. So when that VC associate does their assessment of your business, are they going to find the triggers? They're going to make them put you on the right side of the desk rather than the left side of the desk, if you like.
Okay, cool.
So, and that's, again, it's generic initially because there are things that every investor is going to want to see, and then it gets very specific. So time taken to make your pitch specific to the individual investor, to make sure it resonates with the things that are important to that investor, even if it means you've got 45 different versions of your pitch deck, really important. So the only way to play that numbers game is to do great research about who the potential investor universe is for your business. And that might not just be VCs. Realizing that VCs only invest in a tiny percentage of the businesses they look at. So making sure that you really focus and target your effort on getting the right story in front of the right investor. But there is another thing. There's been, and it's a little bit less the case now, simply because fundraising is more difficult now than it was a couple of years ago. Do you really need to fundraise? Do you really need to raise that amount of money? Can you get by with doing this a different way? Because if you're putting all of your efforts into being the 0.5%, one of the 0.5%, actually the 0.05%, then that is a tough gig. And there's actually a startup mentality thing that comes into play. Yin and yang of being a founder. On the one hand, the founder must recognize that they're much more likely to be part of the 90% failure stat than the 10% success stat. Simultaneous with putting everything they've got into their business. And that messes with your head. If you really go through the numbers, why would I be part of the 10% success story rather than one of the 90%? In my case, and this is probabilistically wrong, because each time you flip a coin, it has an equal probability of being heads or tails. I say, well, I've had enough knockbacks over the years to think that maybe I've hopefully learned a few things that will allow me to be more successful this time around. But that's ultimately this really key element of what's driving you as a founder. To believe that you can make that difference within your own business, within the marketplace as a whole, and within the economy, to be part of that 10% statistic. And having the drive and the energy and the commitment to see it through.
Because all of the time that you spend, and it's a significant amount of time raising capital is time that you not spend actually building your business. So, the other, we're doing this dog fooding kind of series right now about going through this process ourselves as Intanify, and I actually kicked it off by actually asking the question, should you raise money? And the other way to look at it is, if you do take VC money, you bet the company every time you do, because you've promised someone a 10x return. Which, if you've got product market fit, which in a lot of cases you might not even start that way, you've got a certain revenue profile which you've actually got your arms around. To promise 10x means you have to have a new product market fit. It was pretty hard to get it in the first place, and you've got an X% chance of getting that done also. So you only take the money if you really feel that venture capital's got a good value proposition to you, and that you to venture capital have a the right profile business to kind of work for them. And if you don't, it's probably going to be a pretty ugly marriage. But
Correct.
Yeah,
And I think we always say this. I've said this to many people whenever I get the opportunity. Fundraising is not clever. It's not an end
yeah,
in itself. Being part of that, well, I did my seed stage, I did my Series A, I did my Series B.
mm,
Those are not badges of courage.
mm,
You could even interpret them as failures in your business model, that you've needed to go back to the market that many times to raise money, because it's each
yeah,
time it's taken you 50% of your
yeah,
headspace for the best part of a year. So
yeah,
uh, that's an extreme view,
mm,
but given the market stats,
yeah,
2,000 investments out of a potential pool of
mm,
150,000, and given some of the other issues that you may get by taking VC investment, which is you've got
mm,
somebody else um, wanting to take your business in a certain direction,
yeah,
and with their own success criteria, which may not be shared.
yeah,
Um, there are plenty of reasons for not doing it, and I think
yeah,
many accelerator programs over the years have sort of said this is the way. We're
yeah,
preparing you to get on that roller coaster ride
yeah,
of multiple fundraisings.
yeah,
And actually, we've taken this decision as a business, as Venture
mm,
Cubed,
mm,
to build organically and not seek external funding,
yeah,
on the basis that we're doing quite tricky and in some ways quite volatile things from a technology perspective,
mm,
that we need to do sort of on our own terms until we reach that point of clear stability as a business.
yeah,
And from that point on, potentially the need to really scale.
yeah,
So, do you really need to be doing this is kind of question one. And
yeah,
maybe we should
yeah,
include that in our rating, actually. Maybe that should be a question.
yeah.
Explain why you think that this is actually the right way to go for your business.
Yeah, and if you don't have a good answer for that, probably you don't have a good answer for many other things, because it's as fundamental as you get. Cool. Look, I think that's a good place to end it. So, Richard, thank you very much for your time. It's been a great conversation, and we'll look forward to talking more about about how IP fits in your success predictions.
Dylan, it's been a pleasure. Thank you very much.